Well, hello, everybody, and welcome to this edition of the NZX virtual investor event. My name is Doug Vrame. I'm from the Issuer Relationships team at the New Zealand Exchange. Today, we've got three presentations, and we're happy they've all taken the time to put some thoughts together and share it with us, as we're really looking forward to hearing from everyone. I'll explain that in a minute. Just a reminder of the format quickly. We'll hear from each presenter for 10 minutes. And that will be followed by 5 minutes of Q&A. We encourage you to ask questions. Anything you want to ask, feel free. The way you do that is in the text box of your presentation screen. You can ask questions, they'll come to us, and then I'll ask them to the presenters. Anything we don't get to, we will follow up with offline and get them back to you. We'll also send out a link for you can watch the video again, or if anyone you know has missed it, on YouTube. And that should go out after the event. So let's get started. We'll start here with Tim Malloy. Tim is the CEO of Geo, and he's joining us from Sydney this morning. Geo is a leading software provider for mobile business owners involved in job management and project management for field services. Tim joined the company as CEO in February of 2020 and is a seasoned executive and tech entrepreneur with extensive experience in high growth service businesses. So I will turn it over to you, Tim, and we'll be back in about 10 minutes with some questions. So thanks.
Thanks so much, Doug, and thank you everybody for joining the investor presentation. It's nice being a New Zealand company and being a Kiwi myself, but I'm beaming in obviously from Sydney, so it's kind of cool during this pandemic that we can do this sort of thing. What I'd like to do is just tell our Geo story and about where we've got up to and what we're doing. But to do that, just in case there are people on the call who don't know who we're about, I'll just run through very briefly what our product's about and who it's for. Quite simply, we say of ourselves that we're smart software for tradies and home services businesses. There are around 310,000 of those businesses in Australia and New Zealand, employing about 800,000 people. So, and we have a good number of tradies using our product every single day to go about their business. The thing that we do for tradies is all of these things that you see on your screen now. We effectively, if you think about a tradie who you've got a leaky tap at home and the tradie wants to turn up to, or you need a tradie to turn up to help you with that leaky tap, then it starts off with a quote. You get a quote that's typically done on our platform. It then goes directly into, once you've accepted the quote, it schedules that job. It goes to truck number 3 or number 4 or whatever it is, and the truck turns up at your place at 3:30 this afternoon with a couple of tradies on board to fix your leak, in this case, your leaky tap. So they get the job done using our platform as well, with checklists and about knowing the job and knowing the client. And when it's all done and the leaky tap's finished, etc., then they'll do the invoice and the payments. And we play really nicely with Xero and MYOB and Quick, and the invoice goes into those products, and timesheets also go into those products for payroll. And of course, that then means that the tradie has got their record keeping all up to date. So we help tradies and field services businesses to run their businesses better. We typically get tradies that have got, or tradie business that have got about 3 to 15 team members. We look after businesses that are much bigger than that, but they start with us at about the point they need to systematize and get their business actually running off pen and paper and onto a system. So when our tradies get onto our product, it reduces their admin, it maximizes their efficiency, it improves their cash flow because they're collecting their jobs, they're producing their invoices and collecting the debt at the point of the job. And we have about 14,000 tradies and home services businesses, mostly in Australia and New Zealand, using Geo every single day to run their businesses and do their jobs. So we say to these tradies, and well, they say to us actually, that what Geo does is help grow their business, and it helps them get back in control, not only of their business, but back in control of their lives. So it's a very large addressable market for us. There are, as I said before, there are around 250,000 businesses and 800,000 professionals in Australia and New Zealand that fit into our target market. We get about 16% of our business from overseas, and half of that, or 8% of it, comes from the UK. So in order of our market sizes, Australia and New Zealand are our biggest market, and the UK at 8% is our next biggest market. As the slide says, we're targeting businesses got 3 to 15 employees. We're targeting businesses that are growing, and they're migrating from pen and paper. And the UK market, which we've really just started into in the last little while, is estimated to be about 4 times that size as well. And we've already had some really encouraging metrics out of the UK market, just in terms of our the metrics for acquiring customers and our cost of acquisition, etc. Our priority segments are builders and carpenters, maintenance people, electrical, cleaning, plumbers, painters, etc. I mean, most people know who tradies are, and the average home in Australian users, Australia and New Zealand, has about 4.2 tradie interactions per year. So it's an infrequent interaction, and we look after those priority segments that you see on the screen. We have a deep understanding of our segments. Last year when I first joined the business, one of the things we had to do was really get a close product market fit and make sure that we knew exactly who our target segments were and be able to rifle shot our marketing dollars and our whole go-to-market approach to those customers. And it's turned up in some of the numbers that I'll go through at the moment. The business has a good quality executive team running the business. We're a team, I think, that could easily operate a business 3, 4, 5 times bigger than the current business. There's myself. I'm helped along with Scott Player. Scott and I joined the business about the same time in February last year. Scott is probably one of the best digital marketers I've ever worked with, and he controls our go-to-market area. Peter Hind, our Chief Financial Officer. We're really lucky to have Peter. He's probably way too advanced for a business of this size, but he provides our CFO and our advice for the financial side of the business. And then Minas Camel, who is our head of product and development. One of the things that in having a small exec team like this means that it's good quality, the team know their business now, but it also means that we're really tightly aligned to where we want to go as a team. So what has happened in Geo in the last year? It was really a year of 2 halves. I've approached this business, my particular thing in life is finding good quality businesses that have got a good quality product and just need to get a good quality business going around them. And so that first phase is helping the business get organized and cleaned up, and we're through that phase. The second phase is the growth phase, and we're halfway through that growth phase at the moment, which is the first half is establish that growth and the second half is accelerate that growth. So FY21 was a real transition year for us to establish those growth numbers. As I've already suggested, we're working in a really large addressable market. 1% of the addressable market for us has an annualized recurring revenue of about $5 million, and that's more than we're doing at the moment. We've proven now with our market efficiency that we can now acquire customers at profitable rates. And that's typically in a SaaS business, if you can have your LTV to CAC ratio, which is your lifetime value, how much your customer pays for you over a period of time, compared with the cost of acquisition, your LTV to CAC. If you can have that above 3, then you're acquiring customers profitably. And we've proven now in this business that we've got the business to that point. Our new customer ARR has been growing. Our Q4 run rate was around 139% up on the prior comparable period, and we're growing at about a 24% annualized growth rate. And our retention is strong as well. SaaS products like our own working in small to medium enterprises, if you can get your retention rate up around 89 or 90%, then you're doing really well. And we hit 90.5% in across FY21, and that was despite the COVID interruptions during the year, which I'll talk about more in a minute. We've achieved all of our KPIs that we set out to do. When I first joined the business, we did a round with the investors, and like we said, these are going to be our KPIs for the year, and we've achieved all of those KPIs. And of course, then our capital requirements, customer acquisition, retention performance that allows for a higher return on investment on incremental capital. So what do the numbers look like then? There's two graphs here on the screen. The left-hand graph, which is the red one, really shows over a 2-year period the company's history in spending money on marketing activities. In FY20, there was a lot of money spent on marketing activities, but it was probably fair to say that it was not necessarily really directed and targeted. We pulled that back during COVID, which was in Q4 of FY20, as we reorganized, and then we've been gradually increasing the marketing spend, rifle shotting it directly at the target segments that we want to go after. The LTV to CAC ratio is followed that suit as well, in that you can see in FY21, gradually we've been improving the LTV to CAC ratio to the point where in June 21, the LTV to CAC ratio is now 3.2. We are now profitably acquiring customers in a large market. And the money slide is probably this one here, is that it shows then in FY21, we're now starting to achieve consistently the growth rates that we're determined to get. So in Q1 21, we were 50% up on the prior comparable period. In Q2 in 21, we're 124% up. In Q3, we were 279% up. And in Q4, we were 292% up on the prior comparable period. So we've established these nice, good, solid metrics of growth in the business. Now, like all these businesses, they'll have their ups and downs over time, but when we take a quarter by quarter approach to looking at that growth rate, we're pretty comfortable with where we've got to now. And of course, the ARR, the annualized recurring revenue, that's following our success as well. So it's a lag, obviously, because it's a compound effect. As a customer comes on in month 1, month 2, we have their annualized recurring revenue plus the new customer, month 3, etc., etc. So in Q3 in 21, we were up 76% on the prior period, and Q4 we were up 139% on new customer ARR. And our run rate at June 21 was a 24% growth, annualized ARR growth run rate. So we've pulled the business up from sort of hovering around 10% annualized growth to more than doubling that to the 24% annualized growth rate. So all of that will be terrific as long as we're keeping customers, and we are. Our retention now is stabilized at around 90%. We've spent a lot of time and effort in the business in the last year really ensuring that we're looking after our customers, and it starts off right back with redesigning the user interface to make sure it's more elegant and more easy for people to understand, all the way through to making sure our response times are on average around 30 seconds for our customers. So our retention rates are right up high. It's been interesting for us during COVID. Initially, when the first COVID hit, if you all recall that all economies around the world got spooked. A lot of people took 20% pay cuts. People pulled back their business. Sorry, I just turned that off. People pulled back their business, and it was a difficult time for a short period of time. In our case, a lot of our tradies and home services business, some of them might have pulled back the number of licenses they had, but almost all of them stayed with us. Our experience now as we go into a lockdown is that we come out of these lockdowns quite quickly, and in fact we come out of the lockdowns a little higher than we went in. So the business, Geo, is proving to be reasonably resilient to these COVID lockdowns. And of course, as populations around the world start to get vaccinated around the 80–90% rate, we're starting to see economies open up in a more permanent way as well. So that's our story for the year. Our performance against our KPIs, we said in one of the focus areas was that we would have a 20 to 30% annualized growth rate. We achieved 24. We said that we would have a 90 to 92% annualized retention rate. We achieved 90.5, and we said that we were targeting 3 to 4 in our LTV to CAC ratio, and we achieved 3.2. So finally, the markets are starting to reward that behavior, starting to understand that there's adults running the business, that we can, that when we say we're going to be doing things, that we actually do them, and we get the numbers coming through. So finally, just a slightly forward-looking view, which we've already put up on the exchange in our annual report investor presentation, is that for FY22, we're now going to lift that target to say that we're targeting 40 to 50% ARR growth before churn. We're targeting a similar retention rate of 90 to 92. It's very, very difficult dealing with SMEs to get much above that. And we're targeting a greater than 4 times LTV to CAC ratio for the year. So in 15 minutes, that's the Geo story as it is at the moment. So Doug, I'm going to hand back to you.
All right, Tim, thank you. That was excellent information. We do have questions coming in, and I'll try and get to a couple of them. A lot of it's around the growth and acquisition and competition, and how is this a real crowded space, which I think it is. How do you stand out? How are you acquiring customers and kind of differentiating yourself against the competitors out there?
Yeah, it's interesting. There are about 4 players in the marketplace, Doug. We're all much the same sort of size. And interesting enough, we don't run into each other most on a case-by-case basis, which kind of validates that idea that it's a big market and we're all growing in that market. Our go-to-market, which I think was another part of your question, is entirely about very focused on each of the segments. So when, for example, the pandemic's hit, one of the first things, home services business that's really had a boost is cleaners. So we'll target cleaners. They come to a cleaning landing page and we speak their language as they go. So it's allowed us to get our cost of lead acquisition right down, probably about a third that it was a year ago, just by doing that. And we're picking that model up and applying it to the UK and getting some early results out of that as well, Doug.
So there was a question, and thank you, about the UK and the entry into the UK. When did you start entering that market?
Well, we've been in the market for a while, but in an accidental sort of way. We've been spending our marketing dollars in Australia, New Zealand, and almost collateral to that is people in the UK have found us and have bought our product. We started really going into the UK probably about 2 to 3 months ago, and building up from there. And that's meant allocating team members to that so that they're working that time zone, etc., both salespeople and then support people, etc. So it's been a gradual build for us over the last 2 to 3 months.
Awesome. So there are a bunch of questions. I'm gonna end on a couple more that are kind of tied together. Talking about your current cash on hand versus your burn rate. Are you going to run out? If so, how will you fund future growth? And I guess along those lines, are acquisitions part of the strategy at all? If you did raise money and to accelerate the growth, is that something you guys are looking to do, or will it be more organic growth?
Okay, so let me answer the first question. Is we raised $2 million last year when at a share price that was around 6.5. So the investors who came with us at that point have doubled their money. I see the share price hit around 13.8 or 15 this morning. So they've more than doubled their money. So we've got a really good supportive shareholder base there now because we're producing the results for them. So if and when we get to the point of saying how we fund the acceleration process, I've no doubt that we'll get some really good quality follow-on investors for that. In all of these sort of turnarounds, there's a 3-phased approach. Like I said, clean the business up, get the growth, and then the third phase is optionality, and that leads to are there acquisitions to be made? We're always on looking at that, if you like, but our focus right now is about our growth story, and we'll continue to focus on that for a while. We have advisors working really closely with us around that third phase, but it's all theoretical at this stage. Our focus is entirely on the growth story at the moment, Doug.
Awesome, Tim. Fantastic, great work. That's super helpful, and appreciate you putting the slides together and sharing your thoughts. So there are more questions, and if you have more in the audience, send them in, and we'll get them to Tim, and we'll get them out to you with the link. So thanks a lot, Tim. Appreciate it.
Thank you.
So now we will hear from, there she is. We've got Janine Granger. So whereas Geo is a listed company, as is NZME, Janine Granger is with a firm called Easy Crypto. She's the co-founder and CEO of Easy Crypto. They're a private company that's had some rapid growth and getting a lot of interest. And we really appreciate having her on, and again, putting some thoughts together and slides to share. Easy Crypto is New Zealand's leading cryptocurrency retailer. Janine founded the company with her brother Alan in 2017, and since then they've launched into Australia, South Africa, and Brazil, and probably others. So I will turn it over to you, Janine, and you can tell the story, and then we'll be back in a few minutes with questions. So take it from here, and thanks.
Cool. Thanks very much, Doug. And thanks for having me on the webinar. So hopefully my screen is visible now. Which screen am I sharing? Sorry, this worked so well before. Let me know, Doug, if I'm not sharing the correct screen. It is.
I think you, whoops. I think you had it. We could see the slides just a minute ago, a second ago.
Okay, sweet, perfect. Sorry, it doesn't show me what I'm showing you. So if you can see the slides, that's fantastic.
Yep, you got it. Yep.
Cool. Great. As Doug mentioned, we are not listed on the NZX, but we are just closing our Series A round at the moment, which will possibly be one of New Zealand's largest ever first funding rounds for a company. And seeing as we're not listed for investment in Easy Crypto, I thought I'd give you guys a bit of a run through on cryptocurrency as an investment and asset class in its own right and provide a little bit more color on that. So what I'm going to cover today is what cryptocurrency is, so a bit of a 101 on that, and also why people purchase or invest in crypto assets. So in a nutshell, cryptocurrency is a way to exchange value. So very similar to any other concepts of value exchange that we've had traditionally, except for a few key points. One is that it's fully digital. So there is no physical asset, or there is no offline ledgers or entities backing the crypto assets. They are fully digital and fully exist online. They're decentralized, which means that there is no central entity controlling access to the network, verifying transactions or validating transactions that occur between parties. So it's like a giant peer-to-peer network that's global and doesn't rely on, say, a bank or a government or a MasterCard to process and validate transactions. And lastly, it's completely trustworthy. And this is a really important point, obviously, for any payment network, that all transactions that are entered into are completely reliable and authenticated. There is no ability for a transaction to be reversed or to be fraudulently changed or altered in any way. Once a transaction is made, it is locked in and it's uneditable. And cryptocurrencies are very diverse. So I think, one that gets a lot of headlines is Bitcoin, but that's really it's a generation 1 cryptocurrency. It created the concept of value of a digital payment network, but it had a lot of flaws in things like energy consumption, speed of transactions, capacity of the network are all issues with Bitcoin. And I like to liken cryptocurrencies to your mobile phone. If you think of the very first generation of mobile phone that you had, probably an old Nokia or an Alcatel, or maybe even earlier, one of those giant bricks, so you could plug into your car to power it. Those, very first early mobile phones, they did the same sort of job as a mobile phone today, but so different. And those, that technology has evolved massively. So it's one thing to bear in mind, and if you see criticisms around Bitcoin and around crypto assets, they're typically criticisms leveled at generation 1, and we really need to remember that humans are incredibly innovative and we're great at solving problems when they arise. So generation 2 solved some of the problems that came out with generation 1, and they also brought in this idea of a platform. So I've used Ethereum as the example here. It's a platform cryptocurrency that others can build on. Generation 3 operate less like a blockchain and more like a cluster, or there's different mechanisms that they operate on. In generation 4, I'm not even sure if we've got there yet. So it's really a very exciting space and a lot of change, and it's evolving fast. Some of the types of cryptocurrencies or crypto assets that we have at the moment include payment currencies. So there are certain currencies that are, say, denominated in US dollars. So the rate of those currencies don't fluctuate against the US dollar, which can make it useful for remittances. We've got infrastructure currencies, like I talked earlier, with those platforms that you can build on. There's a lot of things happening in wealth and financial services. And if you've heard of DeFi, or if you haven't heard of DeFi, I definitely recommend taking a look into this. So this is an area that basically there is replacements for all of the traditional financial products and services that you get with wealth, such as lending, escrows, derivatives, swaps, securities, all of these things through decentralized networks, which don't require central parties or intermediaries to make them run, and they've got all of that trust and all of that digital aspects of a cryptocurrency. There's also service cryptocurrencies, things that have real world application like file storage or voting, and even with things like TradeWindow, who you would have seen the news of recently, they are using blockchain technology to manage international logistics, and that sort of network can often have a cryptocurrency associated with it. And then of course we've got the entertainment tokens, things like NFTs, which I'll touch on a little bit later as well. So that's a bit of a very quick 101 on what cryptocurrencies are. Then the main question that people have is sort of why do people adopt and invest in them? So as per the previous slide, there's a whole different range of types of crypto assets out there, and in many respects they look a lot like traditional assets. So for example, Bitcoin is often referred to as a digital gold. It's a store of value. You can put your funds into it. It's not necessarily very good as a payment currency. It's volatile. It's not the fastest or cheapest for doing international remittances, but like gold, it's a good sort of safe haven within the crypto sphere. Saying that, crypto is still very, very volatile, but Bitcoin is more and more becoming that store of wealth asset class. You've got infrastructure like Ethereum, which can operate a bit like like an airport stock. You've got a piece of infrastructure that other entities use. So as airlines use airport infrastructure and pay for the use of that, tokens and other projects use Ethereum's infrastructure. And people who hold part of the Ethereum network or have, effectively like the shares or the assets, get increase in value from their asset that infrastructure being utilized. You've also got startups, and there's a lot of really interesting projects always coming out in the crypto space. And much like investing in angel or seed investment, some will fail, some will succeed, and it's a bit of a, take a punt at a few things, don't throw your life savings in, but you might end up with some projects that really have legs and make a lot of good value on your, good return on investment in the future. And then, of course, you have art. So art's always been a great asset class for, high wealth individuals in terms of, expensive paintings, even things like wine and stuff like that as an asset. And we're now seeing similar things in the digital space. So all of the other asset classes that I've talked about here are fungible, which means that you can exchange one unit for another and they're really the same thing. Same with stocks. If you have one stock in Air New Zealand and someone else has a stock in Air New Zealand, they're really the same thing. They're fungible, they can be exchanged. Whereas art and NFTs are inherently non-fungible, and this is what makes them special and what gives them value, is that they are unique. So if I own this particular CryptoPunk here, there is only one of it, I am the owner of it, I can prove my ownership of it, so it's like a collectible. And there's a lot of, I think, really interesting use cases that we're going to see for NFTs coming forward. At the moment, they're really just filling that space of like art, like collectibles, but they have potential in the future to prove ownership, to prove identity, and to have a lot of broader use cases. So investors are interested in crypto for a couple of key reasons. The first one, and the one that I see most commonly talked about through my customer base, is around diversification. So if you have a wealth portfolio, you want to diversify across different asset classes, and cryptocurrency is just another one of those asset classes. A lot of studies that I've seen sort of recommend between 5 and 10% of your wealth put into crypto assets, and then also within crypto assets would highly recommend diversifying. So I think I looked yesterday and 78% of my customer base have more than one crypto asset. So people diversify into crypto and then they diversify within crypto as well. As a diversification strategy, it's also a potential hedge against inflation. Cryptocurrency is showing signs that it is becoming more and more decoupled from other assets, which helps with the diversification, and also it does not have the inflationary properties of traditional currencies. There will only ever be 21 million Bitcoin in existence, and that is a capped fee, capped limit, and so the price will go up if demand keeps increasing, and there won't be more Bitcoin minted like there is with traditional currencies, that more gets printed over time. And lastly, and I think most importantly, it's not just about speculation. There is a lot of investment driven into cryptocurrencies that is about the underlying use cases and the potential of those assets and the projects that are being delivered on the blockchain. And on that point, crypto assets are quite significant globally. So I pulled this data this morning from global market stats of assets by market cap. Bitcoin is the 9th most valuable asset in the world, has a higher market cap than Tesla. And if you look at all cryptocurrencies together, they sit here between Alphabet and Saudi Aramco as the 5th most valuable asset class. So I think I'm almost at the end. There's just one thing that I often get asked from people is like, what is crypto worth though? It's not backed by gold. It's not a thing that you can touch. Like, how does it actually have any value? And one of the great counters to that, I think, is the challenge for us as humans to understand technologies that are new and to see the value in things before they become day-to-day reality. And the internet is often compared to cryptocurrency as an invention or a change of similar magnitude. But there's a lot of comments like this from the beginning of the internet where it was like people just couldn't conceptualize that value shift and the real value it could be. But at the end of the day, supply and demand is what drives value. And like I mentioned earlier, there is with many cryptocurrencies a fixed supply. So these are deflationary assets. They do not keep increasing in volume. But on the demand side, you've got all of those drivers that I talked about before around diversification, hedges against inflation, and also an amazing range, an increasing range of use values. So the last slide that I'll leave you with is just a bit of a thought around where we might be in terms of cryptocurrency. And again, comparing to the internet, which had a huge increase over time, but sort of back in the late 90s, the value of the internet in the future wasn't really understood and wasn't yet conceptualized by many people. Similarly with cryptocurrency, people like me believe that there is a huge revolution and value shift that this will create, but we're just at the very beginning of that, and that true value isn't yet fully understood. Thank you very much. I'll flick over to questions now.
Awesome. Thanks, Janine. That is super interesting stuff, and I know it's something that we all have a lot of questions on. There are tons of questions here, a lot about security around regulation. Let me start with one that's kind of a good one. Is your funding round closed yet? And if not, can we still participate?
We were closed, but we've had, as is always the way, there's always a little bit of tinkering around the edges of investors being in and out. So drop me a line. We're not taking small investments, but for reasonable size investments and particularly strategic investment, we're willing to have a chat.
And then talk a little bit about there's questions about the SEC and the push for regulation and how this is going to evolve in terms of the regulatory environment out there and what your thoughts are about that.
Yeah, so for my organization, regulation and compliance has always been a really, really important part of how we operate. It's sort of like from day one, we sat down with the AML, CFT Act, the FMC Act, and was like, right, how do we build this business to be compliant? And I think coming from an industry like crypto, where we have a little bit of a black mark on our name, we've always wanted to be whiter than white and take that side of things very seriously. And it's really heartening for me to see now more and more regulation coming out of the space. When we started, crypto was a bit of a wild west. That meant operators who are fast and loose could, potentially get an edge on others, but it wasn't good for the consumer, for the end customer, and it's not good for the industry as a whole. So we have a good regulatory environment in New Zealand. Obviously, overseas, these regulations are increasing, and we're seeing players that don't comply with the rules getting sort of shut down and blacklisted, which I think is great for the industry because that credibility that it brings to have good compliant regulated players is really important.
And on that note, there's talk about, I'm sure you spend a lot of your time many of your conversations around education and answering questions. And what are the biggest misconceptions you hear and see about your company, about Easy Crypto, and how do you kind of change those?
About Easy Crypto or about crypto and more
Well, broadly? The question is, what is the biggest misconception about Easy Crypto? But that might mean just about the asset class in general.
Yeah, I mean, I don't know that we really have much misconceptions about us per se as a company. Like, we're New Zealand based, we really engage with our community, and we're very, upfront about what we do. But around that asset class, there's a couple of really big misconceptions. One is it's bad for the environment. Another is that it's mainly used by criminals. And a third one is probably that it's just a fad. So I can very, very briefly talk to those. But the environmental one is really interesting because, like I talked about, that evolution of the asset classes, that first cryptocurrency, Bitcoin, uses a underlying technology that requires a lot of energy. However, 90% of blockchains do not use that technology. They've evolved to better, faster, simpler, more less energy intensive ways of working. And even for the Bitcoin network, it has, I think, something between 50 to 70% of renewable energy, which is way above any country in the OECD or any country globally, actually. So it's a really, it's a very small part of our industry that is energy intensive, and the part that is energy intensive is very green, and things are improving. So That's the story that you don't hear. And about criminals, like that one just cracks me up because every single transaction on the blockchain is traceable and it's publicly visible and everyone can see what's going on. It's very transparent. So when I go around talking to banks and regulators about this kind of thing, it's a sign to me that I've done my presentation right. At some point someone says to me, so why would anyone use Bitcoin for laundering money? And I'm like, yes, that's exactly it, because it's a terrible way to launder money. You shouldn't use a publicly visible, transparent network if you want to get away with something dodgy. And the more that regulation comes into play in this space, the harder it will be for anyone to get away with bad activity on the networks.
Yep. So those you covered some other questions that came in about the energy and the environmental impact and all that stuff. Last question, then we'll move on. But there will be more we can shoot to you. In terms of the security and the systems that this runs on, and well, there's a question about does it run on AWS, Azure, other types of platforms, and how secure is that stuff? And if there's only 21 million coins minted, can people get in there? I guess is it at risk?
Yeah, so it's a really interesting question. I'll take a little bit longer just to unpick that one. But firstly, the network itself, that Bitcoin, as an example, Bitcoin runs on the Bitcoin blockchain, and that network is fully decentralized. So I can run it on my computer, you can run it on your computer, someone could run it on an AWS hosted instance, but it doesn't have any central place that it exists. It exists at all of these locations independently at the same time. So that's what makes the Bitcoin network impossible to hack, because there is no place to hack it. It exists all around the world, and the more people that run the network, the more robust and the less able to be hacked that it is. So Bitcoin's been going for over 10 years now and has never had any vulnerabilities or hacks, and that's one of its great strengths, is that decentralized model, that it does not exist in any one place. In terms of that's the network itself though, but if you as an individual are buying and holding cryptocurrencies, you have to be careful where you are storing your cryptocurrencies to ensure those are kept safe. So you can store them with centralized entities like, parties like Easy Crypto will be a custodial provider soon, which means you'll be able to store your cryptocurrencies with us, or you can store them yourself in things like, you can get these physical wallets, USB devices that are very secure storage. There's a whole lot of different storage methods you can use, but that's where I think, as retail customers, we need to be really careful and thoughtful about where are we storing our funds. There's also managed funds that are coming out on the market, and there'll be some exciting news out about that hopefully later this week. Watch this space, which enable people to invest in crypto assets without holding the underlying asset themselves. But yeah, don't put your $4 million of crypto in a safe and not have a backup, as we might have seen in the news this week.
Well, Janine, thank you. That was awesome, super informative, and really appreciate it. And we'll get you more questions, but yeah, really appreciate the time. Thank you.
No worries. Thanks for having me on.
So now we will take it over to Michael Boggs, and Michael is the CEO of NZME. NZME is an integrated media company with a portfolio of leading newspapers, radio stations, and digital platforms. Michael was previously the CFO of NZME and was appointed CEO in 2016. Obviously a listed company, so we're back to the NZX listed entities. But Michael, I'll turn it over to you, and we'll be back shortly.
Thanks, Doug, and good afternoon, everyone, and thank you for joining this call today. So I'd like to introduce you to New Zealand Media and Entertainment, and as you'll see here, we're a leading integrated media company. You'll see many brands that you're familiar with, and our purpose truly is to keep Kiwis in the know. Let me start by giving you a little bit of history about the company for some of you. So some of you may be familiar with the three businesses that were brought together to form NZME. Firstly, there was the radio network, which obviously consisted of a number of radio stations, APN, which was a publishing business here in New Zealand, and GrabOne. We used to be owned by the ASX listed APN, now called HT&E, and we were demerged from them back in 2016. Over the last few years, we've gone through a transformation, and in fact, in November of last year, we came to the investor presentation to highlight the three strategic priorities of the business. You can see those on the right-hand side of this chart, and I'll talk a little more about these shortly as we move forward. We're really clear on these three clear strategic priorities for our business moving forward. Just to put it in perspective though, we're 1,200 people in New Zealand. We're across 35 locations. So we're a sizable business from an investing in talent base, and we have a fantastic team who are right across the country, a really diverse group of people and a workplace across many locations, as you can see. These brands should be familiar to many of you on the call, just to put in perspective what our business is. So key brand of NZME's is the New Zealand Herald, which you'll know is the #1 daily newspaper in New Zealand. We launched Herald Premium just on 3 years ago, where we now have 119,000 digital subscribers. We have the Herald website, which for over the last year has been the #1 digital news provider in New Zealand. We have a number of great radio stations as well, so News Talk ZB is a key one, ZM for a more youth audience, and in the last couple of years we've launched One Roof, a property portal. Real estate is the single largest vertical within our overall advertising spend as a business. So you can see we have 32 print publications, 9 overall audio brands, 16 websites, and 17 real estate publications. We reach 3.4 million New Zealanders every month, so a sizable reach across our platform. We're trying to highlight here just where our revenue comes from an advertising perspective. So we've just last month released our results for the 6 months to June of 2021. And you can see there the single largest component there is our audio advertising, which makes up 30% of our overall revenues. Digital, another key component of 15% from an advertising perspective. And print over the years has reduced now to being 19% of our overall revenues from a print advertising perspective. We're seeing really good growth now coming across our new platforms, across digital radio, across One Roof Digital and the New Zealand Herald Premium digital subscriptions. Real key components of our business moving forward. One other key thing I'd just like to point out is around the outside of this chart, you can see the market shares we have in each of these categories. And we have been increasing our market share in each of these areas over the last 24 months. So for example, you can see from a radio advertising revenue market share, we have 40.9% last year. Our digital display revenues, we have 24% market share. Print advertising at 47.8%, and our readership overall of print being 56.7% of New Zealand's overall readership from newspapers. I just thought I'd highlight for the results for the 6 months to the 30th of June, and just to reiterate, this is the 6 months to 30th of June. So in this period, we did see, as you'll see on the right-hand side, our revenue growth and profitability growth for the business. As I came onto this call today, our share price was trading at 98 cents per share. You'll see here a fully imputed dividend was paid on the 22nd of September of 3 cents per share. As I mentioned, fully imputed interim dividend for the 6 month. So, you know, that bodes well for a great yield on a tax paid basis there. Off to the left-hand side, you'll see some of the key metrics and some of the key achievements during the year. So firstly, I mentioned growing our overall radio market share, which continues to be a strength for the business. Continuing to grow our overall New Zealand Herald Premium subscribers with 67,000 people purely buying a New Zealand Herald digital subscription from us, and our overall digital revenues continuing to grow significantly on our One Roof platform. And I'll talk about each of these a little bit further. Cost has been a big focus for the business over the years. So last year we removed $20 million of annualized cost from the business, which is actually helping us and in delivering the improved returns that we're seeing. Finally, to the bottom on the right-hand side, a focus on overall capital management in the business has been really important to us. In this first 6 months of the year, paying down just over $15 million worth of debt. Our debt levels are now below our target debt level. In the last financial year, we paid down $40 million of debt, so the balance sheet is really strengthening. And on that basis, again, just to highlight down the bottom of this chart, our dividend and capital management, again, the bottom here showing how our debt to EBITDA ratio has reduced over time. So the balance sheet is really strengthened now to our debt is only 0.3 times our EBITDA. And you'll see right up the top, our target position is to be at 0.5 to 1 times EBITDA overall. On that basis, the board did obviously declare the dividend, which I spoke about earlier, But importantly, you'll see the last dot there on the page is that in August, the board was actually in a position to approve and announce a capital return to shareholders. That board meeting was literally a few days before we headed into lockdown level 4 right across the country. So we took the time just to pause on that at the moment, and we'll be able to give an update on that in the not too distant future, just as to what the capital management plan continues to be there. So a really strong balance sheet, really strong cash position, and the ability to not only do dividends, but to do capital returns to shareholders. So just to dwell on the 3 key strategic priorities of the business, the first one you'll see there is to be New Zealand's leading audio company. The second one to be New Zealand's Herald, and that's really the focus of making sure we're not seen as maybe a North Island brand or publication, but really a national news service across our digital assets overall. And finally, with One Roof being your complete property destination. And I'll just quickly take you through each of these 3 strategic themes. So to start with being New Zealand's leading audio company, the really first thing we need to do is make sure we have the best local audio content and the best brands overall. Secondly, we want to continue to grow our reach, and the best way to grow our reach is not to do it through transmissions, whether it be into your car or your transistor radios, but to do it into your computers and your mobile phones, and we use iHeartRadio for that. And then we monetize that through growing our overall share, both in the air through that transmission and digitally as well. So last year we did quite a large change across all of our brands. In fact, you'll see here we have 9 radio brands plus an iHeartRadio digital platform. All bar 2 of these had talent changes or music changes or concept changes, which completed in June of last year. So as I take you through these, just really looking from left to right, you'll see, for example, ZM is targeted at an 18 to 39-year-old. It will have a slightly more female skew of 60% to female, 40% to male. That's the target audience that brand's focused on. Whereas if you go across to News Talk ZB on the right-hand side, for example, its target is a 40 to 59-year-old, and pretty even balance between males and female skew there. One new brand we introduced just in the last 12 months is down the very bottom on the left-hand side, and that is Kick. Kick is a digital-only radio brand. It was developed by interns who have just joined us from a broadcasting school. They were given no rules around creating this whole new brand, and they've been given digital channels on our iHeartRadio platform to create what the future of radio should look like from a brand perspective, but importantly sound like, to engage an audience and then being able to monetize it. And we're seeing really great success with that overall. I mentioned iHeartRadio. iHeartRadio is New Zealand's largest podcast platform, but it also carries all of our music radio, all of our music and talk radio stations, plus tens of thousands of radio stations from right around the world. So that is the brand that we use in New Zealand. It's the platform we use to digitally deliver radio in New Zealand, and we're continuing to see really strong growth there overall. So to wrap up the audio segment for our business of being New Zealand's leading audio company, as part of our strategy that I mentioned, we did an Investor Day in November last year, is by 2023 to continue to grow our overall market share, not only in audience, but importantly in radio revenue share by 1% per annum. We want to increase the amount of listening and then revenue generated digitally from a radio perspective from 2.4% to 5%, and we want to see an overall improvement in EBITDA margins in that business. We've seen really strong progress of this since we announced this back in November last year. We're pleased with progress, and we'll be having another full Investor Day in November, which obviously all of you are welcome to be able to dial into. If I now move on to talking about New Zealand Herald becoming New Zealand's Herald, and similarly, there are 3 pillars to this strategy. The first is we want to be the news brand for all New Zealanders, rather than, as I mentioned in the past, it may well have been more perceived as a North Island or even Auckland brand. A big focus around our subscribers and our subscriber first philosophy of having either paid digital subscribers or print subscribers. And then importantly, being a safe and scalable destination for advertisers. So you're going to be in a safe environment to advertise. You're not going to be around maybe fake news from a social media perspective, and being able to really target across our platforms, across all of the assets we have at NZME is a really important focus for us. So as I look at each of those, you can see on the left-hand side there some of the size and scale that we're delivering across the New Zealand Herald. So over 2.2 million Kiwis come to the New Zealand Herald every week from a brand perspective. They spend a lot of time on that site or in our newspapers every day, and 119,000 of them are now accessing us via New Zealand Herald Premium subscription. You can see in the middle there the size of the audience that's growing. So the green line being the number of people that come to the New Zealand Herald site, unique people every month. And in fact, it's not on the chart there, but for August, we just had a record where we've had 2.2 million New Zealanders, unique New Zealanders, come to the New Zealand Herald site during August. The black line being what we see across all of NZME when we take into account all of our platforms. And then finally, just out to the right-hand side, our customer base is growing for the New Zealand Herald. So the bottom grey line is those who are just taking a print subscription from us. The darker grey is those who are taking print and digital subscription from us. And the green is who are buying a digital subscription overall. So we're really pleased to be seeing overall growth and the audiences engaging with the content and continuing to buy it moving forward. So the key things we have from a strategic perspective and deliverables of our KPIs is to continue to grow the number of subscribers, to continue to see the digital transformation happening. So by 2023, digital will be bigger than print from an advertising or from a subscription perspective, and more households buying. You'll see there that digital will become 45% of the advertising revenues, and we'll see good solid strength in the margins overall. So a good underlying cash generating business that is growing overall subscribers. And so then finally, the three pillars of our One Roof strategy, where One Roof will become your complete property destination. Really three components to this strategy as well. The first thing is to strengthen our core listings business. If you were to go onto the One Roof site now, you'd find it would have 89% of all of New Zealand's for sale listings on it. I live in the North Shore of Auckland. In fact, on One Roof, we have more listings than TradeMe or realestate.co.nz for sale on the North Shore than those platforms. The second thing is for us to become indispensable to agents. Let's make sure that we're actually delivering value for the agents, at the same time delivering them leads and being able to help them build their overall profiles on the site as well. And then thirdly, to be able to expand the portfolio. In the last couple of weeks, we've launched a rural section on the site. You'll see more around retirement, and then in the future you'll see more around some financial services or utilities associated with the home. So really making One Roof your complete property destination. So finally, just the strategy that links into One Roof, growing from having the 89% of listings that we currently have to having all the listings in the country is a key focus for us. Absolutely reducing the gap to TradeMe overall from the number of people that come to the site on a daily or monthly basis, making sure we have more and more of those listings paying to be upgraded on the site, because that's how we make the money on our money on the site. Digital will become bigger than print, and there'll be significant margin expansion in this business. So we're really excited by this part of the business. Those of you familiar with Australia will know Domain, and fundamentally this is what One Roof is replicating. So in summary, we think NZME is a strong investment case. It's a market leader in media and entertainment, and as I say, I like to hope you know many of our brands that were on the earlier pages. We have a well-advanced digital transformation that we've clearly laid out and are actually delivering on. We have clear strategic goals which are delivering value-added outcomes. We have a really experienced board and executive team, with Barbara Chapman being our chairman, and we have strong cash flows and capital management, which has been seen in the recent dividend that's been paid, and the intention to pay excess cash and capital back to shareholders as and when we can. Hopefully that was interesting for you. Thank you.
Excellent. Thanks, Michael. That was fantastic. I really appreciate the information. Great overview. Definitely have some questions here, and I will, in no particular order, just jump in. One of them that came up, we talked about the iHeartRadio component. What is the strategic or what are the implications of the expiration of the iHeartRadio exclusivity deal? If
We've got many years left ahead of iHeartRadio, so it's not something that we're at all concerned about.
Good. Okay, that one came up. This another thing, talking about the dividend, the company policy is a good dividend payout. And is there any thought to partial spinoffs to generate cash for new growth ideas which you're not able to pursue currently, if there's tight financial restrictions? Is that something that you guys look to pursue or evaluate?
Yeah, I think from a capital management and investment perspective, that's a really interesting one for us. So, for example, you take our One Roof platform. Could we go invest more and go faster? Potentially the case, but at the same time, we're trying to manage that we're getting good, solid returns for our shareholders and generating cash for our shareholders in the business as a whole. So I think that's something that the board and the executive team will keep under active management, is to how do we ensure that we can put as much investment as possible into growth opportunities while not hurting or hindering the overall business and the shareholder returns overall. Fine balance.
Yep. And there's a question here about, and I hope I don't butcher this, which I might, but about the interchange of, I guess, of data or content between customers, like companies like Google will interchange the data they pull from a customer and then use it in another area of their business. Is that something you guys are doing, or how far along the road to customer interchange is NZME, and what is the dollar cost of having that ability?
Right, so we, as you all have said, noted there, one of our key pillars is to have a safe and scalable destination for our advertisers, and an important piece of that is actually a safe environment, and from a privacy perspective, from the data that we get from all those who use our assets as well. So one of the fundamental things we use, just like a Google, is we want to understand you, we want to understand what you like, and that's what we use from a targeting perspective across all of our assets at NZME. So you'd be able to come to NZME and you could say, actually, I'd like to buy someone of Michael's age who lives on the North Shore, who lives in this type of house, and we would be able to find you on our network, highly likely. We have 800 different audience segments where you can say, I'd like this sort of segmented person to buy. And in fact, if you can give us even more data, we can target right down, a lot smaller than that as well. So it's an area we continue to invest in. We think we're doing a really good job in New Zealand versus our competitors, but we know we've got some global competitors we're competing with at the same time.
Nice, great info. I guess there's one more, and there are a few more we'll get to. This one says, what portion of your infrastructure cost is streaming related?
So all up, from a capital investment perspective, we would spend around $10 to $12 million a year is being spent already once we generate the cash flows of the business, obviously. About a third of that goes on stay in business type replacement type things. A third of it is on enhancing existing platforms and systems, and about a third of it goes to actually, let's develop something new and try some new opportunity. So that might not directly answer the specific question that the viewers got, but it sort of puts it into buckets of where we sort of spend our money overall as a business.
Awesome. Well, I think that does it. There may be one or two others we'll get into you, but really appreciate that overview. Super informative, and thanks for taking the time to speak today. Really appreciate it.
Thank you.
So with that, we will end the presentation. And again, if you have questions from the audience that you want to send in, you can continue to do so. We'll also put the link to the webinar on there if you want to review anything further. So thanks to everyone for taking the time to join us today. Thank you.